morning, everybody, and welcome to the Fred Report conference call for May 5th, 2011. Obviously, we're having a fun week here. Golly, a lot of things changed from the call last week to this week. So we'll get into that right away. I guess the first thing is, stocks may have started this correction that we're looking for. I got a couple of emails on the Cambridge Hook formation. I'll tell you what it is, but it's not something that happens often, so it's probably not what everyone's going to want to watch for. But essentially, it is a key reversal day with a divergence in the MACD oscillator, where the market goes to a new high. The MACD oscillator does not do that, and this is a better one because we've got a double divergence. There was a high back in 2011, March roughly, on the MACD, and then another high just recently in April that was lower, and now this has been a lower high as well. So I guess what I'm saying is it's an odd formation. It usually means the market has lost enough momentum that you're going to get a correction. Honestly, guys, I don't like the MACD oscillator in particular, but I did happen to notice that we had this formation, and I thought I would write about it. So let's talk about a possible corrective scenario, and let's talk about possible levels for that. And again, I did some meetings in Florida, and one of my people at the meetings, who's a very dear friend, very kindly mentioned that levels would be helpful. And my response is, yes, levels are helpful, and I will give them, but what I'm really looking for is an indicator setup. So with that in mind, my first level for the market to hold is 134.50 on the SPY, and that's closing basis. We are below that now. The next levels are 131 to 130, then 126, and then the absolute maximum downside I would have, which frankly, because of the recent trading, is probably called into question, is 122. So we're going to be watching in here down to 131 likely for any real chance to go long this market. We still think there's going to be a strong second half to the year. I do mention, though, caution, because of the sentiment readings, oftentimes the bad news starts to come out, and the correction is worse and a little bit more violent at the end if we get it. The other thing I would mention is the short side of this thing so far has been sort of choppy. We are not closing on our lows. We're going down. We're coming back. That's actually bearish action and suggests more correction because it implies that people are buying the thing and there's hope, but that the buyers are being overcome. But it makes this choppy and difficult to play. A couple of you guys on the call have done rather well on the short side with stuff. I am saying not to be wedded on the short-sided, though, because I still think the big trade here is going to be a long-side trade in the second half of the year. So let's see what happens here. And by the way, the other nice thing about the Cambridge Hook formation is if we take out the high of the hook, which is Monday's high, essentially, on the Bin Laden news, that up open followed by down close, which is the hook, the chance of a correction goes way, way down right away. Way, way down right away. And in other words, the great thing about that for us is it is a benchmark. If we were to get up there and really exceed that area, that would suggest that we got to start adding money back into strong sectors. I also note, by the way, another positive, IWM has come down more than the market, and it has filled the equivalent of the gap on the S&P down at 131, 132. So you're seeing some signs, again, those indexes should get down more. They went up more. The MDY at 176 would be another sort of thing to look at. That would fill a gap, so on and so forth. There's a lot of things to look at, and the main thing is, I think, adding money into the strong sectors. And, we've been very bullish on staples, and that has really worked. And the advantages of staples for us is if the market corrects, staples are defensive. They should outperform. And I also do think that the foreign money that I think is going to come into this market is going to come into those staples type stocks. So let's see how that goes. And we're right in a key area. Very interesting stuff here. And we'll just have to see how it plays out. Bond market. The TLT through 94.50 area, the measuring implication is 97.98. A little bit of resistance here at 95 as well. This is not my favorite trade here because I think rates are going to be higher at the end of the year, so this is a counter-trend move. But nonetheless, I think it's going to work. If you've got guys that are trading bonds, you see the TLT at 98 and you get a nice total return on them. It might be worth cutting back your bonds again. I don't think rates are going to go up a huge amount this year, but I do think that 98 to 100 on the TLT is going to be about it. Again, we're going to look for an indicator signal on that as well. Now, obviously, the fund market, gold and silver, GLD and SLV. Guys, we talked on the call a little bit last week about how these markets can really blow up, and the fact is we're seeing that with this move from 48 down to 36 in a few days. It's worth noting to everybody that the initial margin in commodities on silver, and there's two margins in commodities. There's what's called initial and what's called maintenance. Normally, initial is about 5% of the value of the contract, and maintenance is around 3, and that's just sort of a rule of thumb. I don't know what it is on silver. I do know they've been raising the margin requirements, but if you look at silver down 201 on the SLV today, it's essentially down all of your margin today already. So if you're buying this stuff, you're getting margin calls daily. And in the commodity markets, it's a little bit different than the stock market. They come into your account and remove the money every day when you get a margin call. It's not like you have the ability to drive into your brokerage firm and hand them a check. The other thing to remember about commodity accounts is, unlike stock accounts, at least most of the time, you can get a bill in commodities. They can present you with a bill for $20,000 at the end of the move because the thing went down as much. Whereas at least with stocks, all you can really do is go to zero, although hopefully we won't recommend anything like that goes to zero for you. The difference between zero and negative 10,000 can be rather shocking for a commodity trading client. Obviously, the ETFs can only go to zero, but it's still, that's going to put a lot of selling pressure on the silver if these margin calls keep coming in like this. That's a real concern. Buy points on silver. This 36 area on SLV is first support. If you are willing to take a shot at it, between 37 and 36 is probably a decent try, then 35, and then probably 32. I would also note we have had 3 sharp down days on silver. A lot of the time you have 3 sharp down days, you open down and reverse up. So if you've got someone that has simply got to have silver, you can try the SLV today in this area with the idea being that it could reverse back up and close at 38 by the end of the day and then attempt a rally, and if not, you're at least starting a position. I prefer gold. I prefer the GLD. That's the one that I would be buying if I were buying any of them, and I'm not. Because I'm really waiting for new signals to buy. If you notice the SLV, the stochastic is down, but it has not gone back above 20. We do not have any crossover of the moving average. And on GLD, the stochastic is down, but it's in the 40s. It is not down around 20. So these markets could have further to go on the downside. Commodities have a tendency, including the metals, to make a seasonal bottom in May, towards the end of May, and we could be seeing what's called right translation, which is a bull market that rallies for a while and a very sharp drop into that seasonal low. Let's talk about the currencies a little bit. The dollar looks to me still like it's trying to rally off this general area. We note that the UUP is bouncing a lot more than the DX, although the DX was up yesterday. We also note that we have been thinking that the dollar would rally from the 74 area, and it's now 73.11, so our thoughts have not necessarily been the best and most cogent here. but the dollar is oversold enough. A dollar rally would be good. And what I'm really watching on this, the FXE is the euro, and there's a lot of resistance in the 150 area. If the FXE makes it above 150, very likely the dollar is really going to take it and get in the shorts, so to speak. But as long as we're close to 150 or below, this euro may actually still start to have trouble. And so I would just be a little bit leery and look for this FXE to maybe come back to 142.50, 143, then we see what happens. I also call everyone's attention to, there was a nice report that came out at Merrill Lynch how the dollar and commodities are decoupling. We've been expecting that to happen. They're actually decoupling on the downside here short term, but they can certainly decouple on the upside as well. Remember that if the economy continues to improve, commodities can advance based on their own fundamentals, and the link with the currency is a little bit less important. With that, we're going to turn and we're going to take a look at a couple of stocks here. The first